So, as promised, we wanted to give a bit of feedback to let you know sort of what some of the fund managers in our portfolios are thinking when it comes to local elections for the local portfolios, and then for those that are invested offshore in our offshore portfolios, what those managers are doing considering the potential increase in the war in the Middle East. So starting with locally, there's obviously three sort of major scenarios. The one is extremely bad, depending on the outcome. If the ANC joins with like MK and EFF, and then there's one where it's more would be seen as more positive anyway by investors if it was a coalition with, for example, the DA. And then there's the middle of the road where they just join with a few minority parties to get their majority and carry on. A number of political analysts have been interviewed to see which is most likely, and it seems like the middle of the road kind of sort of bumbles on as it has been, is the most likely scenario, in which case there wouldn't be any major shifts in investment sentiment. And therefore, that is what most of the fund managers seem to be positioning themselves as, but being defensive on sort of that worst case scenario. So, for example, Resco, they always worst case scenario everything. So it's really good to have them in the portfolio. They're like an insurance policy for if things really did go south. But then even like Coronation, for example, are at the moment max offshore to hedge against that risk. Alan Gray, for example, has got quite a bit of local investments, but they're very selective. The types of companies that would really benefit if the sort of best case scenario did play out, they would benefit as much as possible, but be less exposed to a worst case scenario. So they're very selective on which companies they're investing in South Africa, but at least they do have a fair South African component. And then other ones like 91, for example, they've got a lot of gold in their portfolio, so it's done really well lately. But that is always a hedge against uncertainty and bad outcomes, you could say. So overall, if a really good outcome did happen, our portfolios would probably slightly underperform relative to the industry, because it's hedged against protecting our portfolios more from a worst case scenario. If that did happen, then we would definitely outperform relative to the market, or to the industry at least. But most likely, kind of carrying on as it is, that seems to be how most of the funds are positioned. So that's some feedback on that. On the offshore side, it does seem like gold is something that a lot of the fund managers are looking at, trading quite actively, as the gold price goes up and down with the volatility. That there's definitely going to be more and more volatility, up and then good news and then bad news, and trading actively with gold can really benefit a portfolio. So some of the fund managers doing that, but it seems like general consensus is the US market is still extremely expensive. So using fund managers that won't invest in the top, performing funds or companies of the S&P 500, is probably protecting us from a very likely correction in that market. There's a graph showing about 30% of the S&P 500 is trading at a PE ratio of over 30, which is just crazy. I mean, they would need so much real earnings to come through to justify those prices staying at that level. It's just so unlikely. As their real earnings come through and reality kind of kicks in, it almost must drop. So using fund managers that are excluding that portion of the US market from their portfolios is definitely protecting our offshore investors. And that pretty much is a quick summary of what the fund managers are doing in our portfolios. If you've got any other questions, then yeah, please let me know. But we thought that just a nice little brief summary might be helpful.